just like we've done for the last couple of months, we're really looking to do just sort of an overview of some of the key themes that we're seeing in the market. And let's get started. Last month we came together and we talked. I started last month with the same basic framework, which is that the order of the macro linkages matter. And what I mean by that is that it's important to recognize the path that we're going to take from where we were, say, at the beginning of the year, to eventually getting inflation durably back to target. And in that process, it's important to recognize that it takes certain steps to get there, because you don't want to necessarily get ahead of those steps when you're trading markets. And so the first step was rates rise. Now we've seen some rise in rates, a moderate rise in rates, but a big important step that's taken since we last talked was that the QRA announcement with less duration supply than expected created a circumstance where where bond yields came back down, although today they went back up in the other direction, which we'll touch on a little later. Number two is stocks fall, right? So rates rise, stocks fall. They fall for two reasons. One, they fall because of the discount rate rising, creating a downward pressure on stocks. And two, they fall on expectations that those increased interest rates lead to lower economic activity in the future, therefore lower earnings growth expectations. Right now, we saw a bit of a decline in stocks, but the big picture story is stocks are really only roughly 10% off their all-time highs, and those all-time highs were relatively extreme in comparison to history. Then, once stocks fall enough, you start to kick off the cycle or the process that typically leads to recession, which is the fall in stocks, as well as the rise in bond yields, leads to a decline in demand. That decline in demand leads to lower earnings. That earnings decline then leads to job market weakness. That then leads to slower wage growth. And finally, as a result of that, nominal spending slows enough relative to productive capacity to get us to a point where inflation durably declines to the Fed's mandate. Now, if we look at where we are in this cycle, we were about a month ago moving really from step one to step two. We had seen a relatively sizable rise in rates, but stocks had just started to move downwards. But in many ways, what we've seen from a policy perspective is a bit of a reversal on that point. And so when we scan across markets today, this is what you see today, which is that the QRA announcement, which led to, essentially it was a proactive policy announcement by the Treasury, by Janet Yellen, to reduce the type of duration supply that would have been expected given the size of the deficits in order to ease the downward pressure on long-term bonds, created a decline in interest rates over the last couple of weeks, as well as an increase in stocks. And so that's what you see here, just a scan across all these different markets with October 31st, right before the QRA announcement marked, or the composition of the debt marked. And what do we see here? We see stocks are up, have rebounded considerably. We see bond yields have come down. They peaked almost at 5, you're basically at 5. And we're seeing also, in addition, the 2-year rate coming down, which is notable because to the extent that the Treasury is essentially easier than expectations, engaged in a policy decision, it's notable that the 2-year rate would also come down, likely driven by the overall bond market demand and short covering, but in a way that doesn't actually make a ton of sense, given that an incrementally easier set of policies from the Treasury means that there's even more work to be done by the Fed to achieve its targets. And so you wouldn't really expect that, but nonetheless, in sympathy, the 2-year rate came down. And then what we're seeing on the term premium side, it had risen, it came back a little bit, but as of today in today's bond market action, it moved back up. But the big picture story here is that we're very early in this cycle, right? Look at how things are positioned in stocks. We're just off the highs. Bond yields have moved up. And that will over time lead to slower economic activity and should start to create a drag on the stock market. But with stocks basically, just off of their highs, their all-time highs, again, we're still very early in this process. I think one of the things that's been particularly interesting over the last couple of weeks is how investors have taken the incremental news from the Treasury and essentially gone even more all in on the soft landing view than they had been even before that announcement. And before that, they had already been all in on the soft landing. And we see that in the cross-asset market pricing, where the only rational explanation or path forward in terms of macroeconomic conditions that would align with the market pricing that we're seeing is a perfect soft landing. And let me explain that. If we look at the S&P 500 and we look at expected earnings growth, what do you see? You see 12%, 11 to 12% earnings growth expected in the S&P 500 in 24 and again in 25. That's pretty strong, considering that even a very strong U.S. economy is only growing at something like 6% on a nominal basis. You're seeing credit risks, here shown on the lower left by the high yield credit spread, basically coming in very low relative to history, not at all-time tights, but still relatively low compared to the historical norms that we've seen. And then so both of those point to expectations of quite strong growth, essentially very low defaults in the high yield space, very strong earnings growth. That's a picture of strong economic condition. Now we look at what's being priced in on the inflation side of things, and we see that there's been a significant decline in oil prices over the course of the last couple of weeks, and particularly if you then go further out the curve, not years out the curve, just through the December 24 pricing, what you see there is a return to very low oil prices, essentially a big disinflationary impulse. And then finally, when you look at break-even inflation, we're basically stuck at 2%, and people's expectations haven't really changed from that. So when you scan through this, basically strong growth, low inflation, and then I think the last piece, which I think is quite interesting, is what we see a Federal Reserve that is still currently priced to engage in sort of Goldilocks policy over the course of the next 12 to 15 months. And what I mean by that is, if we had expected the Fed, if the market expected very strong growth, right? Odds are the way that would be reflected is you'd expect the Fed to not ease into that very strong growth. If anything, you might expect the Fed to tighten once or twice more, particularly since the dot plot sort of suggested and indicated a willingness to tighten a bit more. But instead, what you see is cuts. And the amount of cuts that you're seeing are 3 to 4 cuts in through the end of 2024. Now, the interesting thing about those cuts is if you thought that there was going to be a recessionary environment, right, you would expect the Fed to cut a lot more. So basically what you're seeing here is a Goldilocks path of Fed policy, where strong growth, low inflation, and just a moderate easing of monetary policy as the economy perfectly soft lands. That's basically what's priced in the asset markets. And it's important to start with this. I know it's not as exciting as penciling out exactly what's likely to transpire, but when you're in the asset markets and you're looking at what's going on, this is where you have to start. You have to start with what's priced in, because anytime you're making your bets, you're betting relative to what's priced in. All your investments are relative to that market pricing. And so even more relative to even last month, an even more significant bet all in on the soft landing. And when we look at the conditions and the dynamics that are going on, is it possible we get a soft landing? Yes, of course it's possible. It has been seen in history. It's not an impossible outcome. I think the question is more, what is the probability of actually getting that soft landing relative to how it's priced? And incrementally, as we go through different asset prices, what's priced in and what's probable? Right? Those are the two things, not what's possible, but what's probable relative to what's priced in. So let's just take a minute to think about that. So here we have, a couple of basic stats here when we're thinking about what's likely to transpire over the next 15 months or so. One of the biggest issues that we have is nominal growth in the U.S. is still too strong. Anywhere you slice it, we look at what the numbers have looked like. The third quarter nominal GDP print, it was 8%. Now, is nominal GDP going to grow at 8% for the next year? Probably not. But we have seen nominal GDP growing at above 6% over the course of the last year. All of this type of growth, when you're comparing it to a labor force growth that is essentially zero, suggests that we're probably growing on a nominal basis at a pace that's just far too strong relative to the labor force growth in the economy, as well as the productive capacity in the economy, which is about 1% or maybe a touch more than that. So 6 or 8% nominal growth is still far too high, far too strong relative to what's necessary to achieve the Fed's mandate. And then you go on the other side and you take a look at some of the price indications. And while there was some indication that measured prices were moderating over the course of the last couple of months, recent data prints have suggested that is not going to be a straight line down in terms of disinflation. And that's what you see over here on the right. The most recent core PCE numbers coming in, in that 3 to 4%. We've seen a couple months of core inflation, CPI measures above expectations, and in that elevated 3, 4, 5% range. And so when you're the Fed, and this speaks to what Chairman Powell was saying earlier today, getting durably to the 2% mandate, which is what the Fed's going for, is not going to be a straight line. And there's a real risk that, and a real recognition by the Fed, that measured inflation may not be on that straight line path. And so there's still a lot of caution that exists there, and for good reason. When you still have nominal growth that's this strong, when you still have price growth that's this strong, it's the sort of combination of things that could very easily keep inflation elevated relative to expectations. And at its core, basically the issue in the economy is that nominal wages are just growing too strong. Nominal wage growth continues to be at somewhere around 4 or 5%. And that is considerably stronger than what nominal wage growth was pre-COVID, right? And these two charts show that very, very clearly. On the left-hand side, what you see nominal wage growth through ECI. That's essentially, all-in compensation growth across the whole economy, still running, it's moderated a little bit from 5 to 4, but it's still running around 4%. In comparison to pre-COVID levels, where it was running around 2. And then on the right-hand side, what you see is the Atlanta Fed wage survey, which basically tracks like-for-like employment by single individuals to get a good of under $175,000. So you get high propensity spender income indications here. And what you see is, yes, there has been a moderation from that 6% level for high propensity spenders down to something that's closer to 5%. But even the most recent data that came out yesterday indicated that that growth rate has moderated a little bit, but it's kind of stabilized in this 5-ish% range, is what you see here on this updated chart on the right. And so you look at all that and you say, okay, that is a very different picture than what we saw pre-COVID. Pre-COVID, we had inflation that was at the Fed's mandate, 1.5 to 2%. And we had wage growth that was around 2% on ECI and around, 3% on Atlanta Fed wage growth. And instead, what are we seeing today? Around 4% on ECI versus 2%, and on Atlanta Fed wage growth, 5% growth relative to that 3% level. And so that's the diff, right? It was easy to bring inflation from 9% down to the 3 to 4% level. But this is where the rubber meets the road, right? This is where just supply chain issue resolution isn't going to get the job done. And so when you look at this, you essentially have more embedded inflationary pressures in the economy than are acceptable for the Fed to meet its mandate. So let's go back to this story here of what's likely to transpire in terms of the Fed pricing. And what do you see? well, you see more inflation, durable inflation pressures in the economy than would be indicative or consistent with a shift to cutting as quickly as is currently priced in. The other point, which, of course, one of the ways in which this can get resolved, and in fact, a story, a narrative, I'd say, that has captured a lot of attention, is that maybe what we're having instead is a productivity boom, which would allow us to create strong growth at the same time that we get declining inflation. And some have pointed to the last quarter of productivity growth in the economy, measured productivity growth, to suggest that the productivity growth boom is here. And that is nonsense. And the reason why that is two core reasons. The first is that productivity doesn't change on a dime, and maybe AI will be a huge productivity boom for the economy, but there is essentially no way that it's creating a meaningful increase in productive output over such a short time as measured in quarter by quarter measures. And instead, I think mostly what we're seeing, if you look on the left-hand chart, is a return or a consistent productivity growth in the economy that's between 1% and 1.5%. That's basically what it's been for a long time. Post-COVID, it was a little softer than that. During COVID, it rose more because of cyclical dynamics going on there. But basically, we're sort of at this longer term trend. And probably even more importantly, this most recent spike up, the question is what drove that? And I actually think in the right-hand chart, what you see is a big driver of that increased productivity is the fact that hours worked have been cut considerably. And so what you see on the red line is the total amount of employment, and on the blue bar is the total number of hours worked. So just think about it like number of workers times the number of hours that they worked, right? In order to get the overall output. And what we see here is that the strong productivity numbers that we're seeing are a function of the fact that hours worked haven't been keeping up with total jobs that are being created. And so by definition, that must lead to higher productivity, but that is bad productivity. That is cyclical improvements in productivity in the economy. That isn't new era productivity. And that's really what it comes down to. One of the core questions that exists in terms of this overall path is, can you get a significant moderation of inflation in an environment where we don't have a significant weakening of the labor markets? And what this shows is maybe it's possible we're getting an increase in productivity relative to wage growth. But what this would imply is that that's happening because there's been a weakening of the labor market. Now, I think there's some statistical noise in this. I don't think it's the real story. I don't think that's the real story. I think employment is basically fine to secularly tight, for those of you who follow me on a monthly basis or on a weekly basis with my tweets on that. In general, it's not like we're having a disinflationary productivity boom when you look at the data. And the reality is, employment continues to be fine, right? Even today, writing a tweet that said, the U.S. labor market remains secularly tight, and all indications are that that's the case. A lot of folks have started, calling up the Assam rule in order to suggest that we're right on the cusp of immediate recession. But when you look at a totality of labor market indicators, so not just the unemployment rate, but look at claims, look at job layoff announcements, look at the employment report, look at the household survey. What are we seeing? We're seeing in general quite a continuation of a tight labor market. And an important reason why that is because actual labor force growth in the economy remains relatively low because of the secular demographic shifts and the somewhat limited amount of immigration we experience in the US relative to pre-COVID periods. And so you put that together, it just doesn't take that many jobs on a monthly basis to keep the labor markets tight enough to keep that wage inflation pressure still in place. And so that's basically what we're seeing a continued tight enough labor market, not to create a boom in wages, but to create a settling of wages at levels that are above what is appropriate given the Fed's mandate to meet on inflation. We're also seeing, if you look at the corporate picture, so that's sort of all, you put that whole picture together, it looks like inflation is likely to not, move straight to 2%, durably to 2%, as is expected by many in the markets. Now let's talk about what's going on with the equity markets. On the equity market side, the basic question is, are we going to see as strong earnings growth as is currently priced in? Remember, the expectations, bottoms up, analyst expectations are 12% earnings growth over the next year, over 24 and 25. So let's talk about how earnings growth has actually played out. Remember, if we go back to what's been going on here, nominal GDP growth in the economy over the last year has been above 6%. In the last quarter, it was measured to be 8%. That is a very strong nominal growth in the economy, right? How are earnings doing? Not well in comparison. And I think that's an important thing to recognize. That is the tightness in many cases that reflects the fact that the corporate environment, the large company environment, just isn't succeeding anywhere near as strongly as the overall economy. And certainly the earnings growth that we're seeing is nothing close to what is being seen in terms of overall GDP growth. And so we can see that in the chart here. We've had, really earnings growth has been flat for the last 2 years. Now, remember, nominal GDP growth has been running at 6% for the last 2 years. Earnings growth has been close to flat. All right. Given how good the environment was over the last couple of years in terms of nominal GDP growth, if earnings can't deliver consistent quarter over quarter growth during a period of extraordinarily strong nominal GDP growth, how the heck are they going to grow 13 or 12% each year in 24 and 25 when almost certainly growth will be weaker in the future than it has been in the past, given the tightening that's occurred in the economy? And I think that's a really critical discontinuity that exists between the expectations that exist in the equity market relative to the macroeconomic realities on the ground in terms of growth. So what are we seeing? Basically earnings growth that's been flat for the S&P 500 and expected to continue to be flat and maybe start to, the boom in earnings is always coming, but it's coming, 6 or 9 months away when the macroeconomic reality is further tightening. So we see weak earnings, reported earnings. We see sales beats that are basically the lowest that they've been in years. And we see, I think we see over here on the bottom right-hand chart, a lot of companies with negative guidance overall through the course of the earnings season. And I think probably actually one of the more interesting things that's going on is we see a fragility in the equity market. And that fragility, I know for those of you who traded the last 10 days, and it seems like stocks only go up. I think under the hood, it's really interesting to see how those companies who have come in with underperforming earnings, how they've performed in response. That's what this chart here on the upper right shows. And it basically shows that the negative earnings surprise companies have underperformed or have fallen the most of any time over the course of the last 5 years or so. And what that really highlights is the fact that when it comes to the equity market, what we have is very elevated expectations, earnings that are kind of mediocre in comparison to those very elevated expectations, and fragility that any time that you see companies fail to reach the extreme expectations that are in the market, they're falling they're falling significantly relative to history. And so that is the combination of dynamics that could easily set up for a meaningful disappointment in the market as we turn to 2024 and the expectations that are built in there. When we look across the developed countries, I'd emphasize just taking a step away from the U.S. I think there's a lot of interesting dynamics going on. When we go back if we go back 12 or 18 months ago, there was a lot of commonality amongst the developed world economies. Like basically central banks were too easy, inflation pressures were emerging, central banks had to catch up. That wasn't really priced into markets. That led to a rise in the short rate and long rate relative to what was priced in. And that was basically a universal truth. But today, things are starting to meaningfully diverge interestingly, at a time when the expected changes in monetary policy between these economies is actually convergent. So divergent outcomes, convergent monetary policy expectations. That's a very important and interesting point that's going on. So let's just run through that. We look at the US, has some of the strongest growth and inflation that is still a bit above, still continues to be above what the target is for the Fed. And what would that point to? That would point to tighter monetary policy, or certainly not a quick shift to easing. You look at the UK, you see moderate growth or weak growth, but inflation, core CPI, remains around 6%, kind of stuck at the 6% level, which is vastly too high relative to the mandate of the BOE. And then you see Europe, which is even different from those, where you have weak growth and inflation, particularly core inflation, which is moderated considerably over the course of the last 6 months or so. And that's what you see on the lower right-hand chart, is you see core inflation month over month, seasonally adjusted, and it matters. You got to do that carefully in the European context. And what we basically see is the last 6 months, it's been running at about 0.2%. Now, is that a little higher than the ECB would like? Sure, but we're certainly in the ballpark when it comes to thinking about the ECB meeting its mandate, and in an environment, I'd emphasize, where their target interest rates have risen considerably relative to what's going on with inflation, right? And so but when you scan across these markets and you look at what's priced into 2024, what do you see? You see the same expected change in monetary policy pretty much everywhere. And so that's what the chart on the left-hand side shows. Basically, what it's showing is the expected change in monetary policy, the curve for each one of these major developed economies. And what you see is the UK, the US, and Europe are all expected to cut in the neighborhood of 75 to 100 basis points in 2024. Well, that certainly is a pretty interesting point when you think about just how divergent the macroeconomic conditions are today across those different jurisdictions. I mean, just think about the UK versus the US. Like, while the US economy is strong, inflation has moderated considerably, right, relative to the Fed's target. There's still more work to be done, but it has moderated. Let's compare that to the UK, where sure, growth has been a little weaker, but core inflation remains sticky at 6%, and wage growth is at 8%. Like, what are the odds that the UK is going to deliver the same monetary policy change as the US over the course of the next year, given the relative macroeconomic conditions? And probably the even bigger divergence is between the UK and Europe, right? Which helps deal with those two jurisdictions, of course, help neutralize the geographic circumstances holding both in Europe. What do you see there? You see Europe and the UK are expected to ease in the same magnitude over the course of the next year. Think about that. Interest rates, real rates on the short end, which is shown on the right-hand side, in Europe currently are positive 2%, and currently in the UK are almost negative 2%. That is a radically different policy environment for those two jurisdictions. And what you see is the same expected change in the future coming from both. That's totally inconsistent with the macroeconomic realities. And so I think what's happening here is that the market participants are kind of applying an equal lens, an equal shift across the developed economies, when the reality is that the inflation and growth circumstances, and particularly the inflation circumstances, are quite different between those different economies. I wanted to touch on Japan because we haven't really talked about Japan in many of these conversations over the past couple of months, and it doesn't really fit the U.S. context, Europe, or the UK. It's a bit of an outlier on its own. And what we see in the Japanese context is something which is basically an economy that doesn't have an inflation problem and is running very easy monetary policy and doesn't really have an inflation problem. And so I think that's important to recognize that many folks we're pitching the basic idea that Japan is the next developed economy to meaningfully shift their monetary policy towards tighter conditions. And look at the reality. There on the left-hand side, we have essentially a core CPI measure for Japan. And what are we seeing? We're seeing it run at about 2% over the course of the last 3 or 4 months, indicative of the fact that core inflation pressures have really moderated in Japan. And I'd emphasize that's during a period where the currency has fallen considerably, which should, on the surface, create quite a considerable inflationary impulse into the economy. In fact, headline inflation over the course of the last 6 months basically lines up solely with the inflationary pressure from the currency translation effect from imported goods. What that means is that there is no inflation problem in Japan. Wage growth is at under 2%. Inflation, once you take out the currency effect, is essentially zero. Japan does not have an inflation problem, despite the fact that it's running incredibly easy monetary policy. And what that means is that while the Bank of Japan is moving towards a more flexible regime where they can adjust the interest rate as they see fit, Japan is not going to be in an environment where there's going to be a rapid monetary tightening relative to expectations. And so what we're seeing in that circumstance, I think, are 2 important dynamics. One, we continue to see pressure on the exchange rate, particularly against those developed world economies that have a tightening bias, like the US. And 2, we see actually a very interesting set of conditions that are bullish Japanese companies. Those companies are continue to price in very, very weak earnings growth at a time when their balance sheets are incredibly strong, which is what you see there on the bottom right-hand chart, and where the continued easy monetary policy is going to be meaningfully beneficial for those economies, for those companies, both domestically and globally, as many of them operate globally, for a considerable time to come. And so the Japanese stock market is totally different from the US stock market in terms of the composition of dynamics, whether it comes to monetary policy, competitiveness, or exchange rate dynamics. And so that's likely to create a very compelling and interesting environment for Japanese companies over the course of the next year or so. And just taking a step back, I think a lot of folks have been all in on the Magnificent Seven in the last 10 days, have certainly sparked renewed interest that those companies will continue to radically outperform basically any other companies in the world. And look, 7 companies can be in a bubble for longer than any of us can remain solvent. And I think the real question is, what is your time frame? What is your time frame to think about how you want to allocate your capital? And if you're allocating on a day or a week or a month, look, chasing bubbles may be the thing that attracts you. But if you're thinking about how do I prudently allocate capital over a multi-year time frame, then you start to have to meaningfully consider the discontinuity of valuations that exist across the U.S., within the U.S. equity market and across the world. That's really what I'm highlighting here. If you go to the right-hand side, the right-hand chart, I think it's pretty interesting to see just how much re-rating there has been of the S&P 500, how little re-rating there has been of the S&P 500, right? That's what you see is basically the S&P 500 PE today is basically, next 12 months PE today is basically where it's been on average over the last 10 years. Now, to be clear, interest rates today are radically more elevated relative to where they were over the last 10 years. And so you would not expect to have the same earnings yield. You would expect to have a much higher earnings yield, given the fact that real interest rates have gone from negative 100 basis points to positive 250 basis points, right? A huge 350 basis point increase in real interest rates should lead to a higher required earnings yield on your stocks. But nonetheless, when you look at the S&P 500 as a whole, what you see is you basically see an unchanged earnings yield over the period for the large cap equity market. But that basically is the only place where you see those sorts of dynamics. If you look across Other areas of the U.S. economy, basically, if you look to smaller cap companies, you've had a meaningful adjustment, even considering the weaker earnings growth that exists for those companies. And so you look at the S&P 600 or 400, et cetera, and you see that they've been meaningfully re-rated, unlike the rest of the mega caps. And then you look around the world, and what you basically see is you see the weakest sentiment for non-U.S. stocks that you've seen in decades. On the left-hand chart, what you see is the difference in the equity risk premium between the U.S. and Europe, which is basically at 30, 40-year lows, meaning that your U.S. stocks are meaningfully more expensive than those in Europe. You're getting almost double the earnings yield in holding European and UK stocks than you are in holding U.S. mega cap stocks. And then you also see it in the middle chart there, where the sentiment on emerging market stocks is basically as weak as it's been since the financial crisis. And so, if your time frame, think about how do I construct a portfolio over a couple-year time frame, and you're thinking about what sort of equity exposure do I want, you really have to start thinking about these areas outside the U.S. in terms of their valuation and how extreme the divergences between U.S. mega cap tech stocks have been relative to how it's being priced in the rest of the world. With that, I'll pause for just a minute. We have a few minutes here to go over audience questions. I know a bunch of you folks have submitted questions in advance, and so I'm going to try to take a look at some of those to start. But if folks have other questions, definitely plop them into the question and answer. If you just write them into the question and answer section, I can start to go through them. Here we go. We will pause here. The first question that we've got here is, sorry, this is, we've got, I'm going to stop this. I'm going to come over here. I'm going to pull up some charts to look at. This is, this right here is master webinar work here. So the first question is, could you discuss or respond to a recent memo by Howard Marks about the attractiveness of credit instruments, of holding longer term credit? And for those of you who are unfamiliar with the piece, well, first of all, you should Howard Marks has great insights that he writes on a regular basis, and definitely worth a regular read for investors. So definitely check out those letters. I've been reading them for 20 years. So, I mean, it's really, they're really good pieces. I think his basic point, just to simplify his point, is that, look, you can buy high yield bonds, and those are going to give you yields that are in the 8 or 9% range. That is close to a long-term equity style risk that you're taking, and much higher up in the capital structure today than where you were before. And so I think the basic question is, are high yield bonds at 8 to 9% really a good deal? And I think the way to answer that question is to really break it into its pieces, because it's not just about the overall yield that you're receiving on those bonds. It's about how you get to that yield and what elements of those of that yield are actually attractive and showing long-term value versus what elements of the yield are not. And so that's where I start here. Just what is a high yield bond? It's basically three pieces. It's credit risk, it's break-even inflation, and it's real yields. And so if we just look at those three pieces, what do you see? What you see here is you see an environment where long-term real yields are basically as attractive as they've been in many decades. Long-term real interest rates offering yields in the 2.5% range. Here I'm showing a 10-year yield is about as good as you've seen, through history, even prior to the financial crisis. And really the only times that we've seen those yields even higher than that in a more recent period were periods right in the financial crisis where there were some liquidity issues in these bonds. And so when I look at that set of conditions, I say to myself, particularly if you think more structurally about the U.S. economy and some of the secular challenges that the U.S. economy has in place, the fact that you're receiving real yield, real return that is on par with 20 years ago is a pretty compelling buy, particularly if you're going to hold it for a few year time frame. Okay, so we've got that piece. That piece looks good. Let's turn our attention to break-even inflation. Break-even inflation is currently priced to be basically 2%. Now, is that a good deal or is that a bad deal? It could come in at 2%, and that would be consistent with the Fed meeting its mandate relatively well, but it easily could be above 2%. We could be, for reasons we've talked about in these webinars before, we could be entering a period of more elevated inflation relative to what we've seen over the past couple of decades. And so therefore that suggests to me at least that break-even inflation at 2% is kind of the best case scenario, not the worst case scenario, which is very different from the real yield. And then let's look at credit spreads, high yield credit spreads, which are roughly 4% today, which is on par with the boom times that we've seen in the past. Now, do I think that there's going to be an immediate wave of defaults instantaneously? No. But do I think when you scan across the world and you say, is this an incredible deal to buy high yield bonds currently priced, currently structured, at yields that are sort of at this level, I say to myself, it's not that compelling a buy here. Now, when you think about that package, you put that together, you basically have some of the best or most attractive real yields that you've seen in a long time, break-even inflation that is certainly not offering significant compensation relative to the inflation risks that exist, and the credit spread component, which is not that great, all things considered. You put that together, and sure, when you compare high yield bonds to equities, right? Equities being essentially the most overpriced asset in the market today. Yeah, it's true. High yield bonds look better than equities from a longer term investment perspective. But the reality is what you're actually doing, what you actually see is that there's real value in the real yields. That's where the real value exists, not really in the other elements of the security. All right, another question which has come up, which I'll jump on here, and hopefully folks can stick around a little bit after the top of the hour. I'll keep answering the questions. People can stick around if they want to. Thank you everyone for coming. I wanted to come to this question. This question was basically share some thoughts on the near and medium term trajectory for the bills coupon mix. And I think that drew me to wanting to show. I think this is a very interesting chart here, which I think we've entered, for decades. Basically, the Treasury was not an instrument in terms of policy. What they was a technocratic implementer of the debt management of the government, and so that they were not meaningfully shifting the way in which they were operating their debt construction depending on what was going on with market conditions. I think the QRA announcement that happened a couple of weeks ago really signals a shift in terms of the policymaking influence that the Treasury holds, where they are going to be responsive to macroeconomic conditions and also responsive to political circumstances in terms of how they execute their policy. I said on Macro Sunday, which is a good podcast from Andreas that you guys should listen to on a regular basis. He asked me what did I think the QRA was going to be, and I said I'm not really sure. I think I'm much more interested in whether the QRA and the Treasury is showing themselves as a policymaker or showing themselves as a technocratic institution. I think we really got good indication of that. And what I'd also emphasize is they actually have a lot of room to continue to shorten the duration of debt before they run into a problem. And I think this chart is a really good one, which shows the amount of, the share of the market that is bills in the market. through time, which has averaged about 22.4%. We've seen that sharp rise that came as a function of refilling the TGA. And now this sort of gives you the range of what could be the possible share of bills relative to bonds or coupons in the market. And what do you see is you basically see a circumstance where even if if the Treasury basically kept coupon issuance flat, the rise in bills, while it would be meaningful in terms of limiting duration supply in the market, certainly would not be extreme relative to the past circumstances that we've seen. And this is assuming coupon duration is flat. Now imagine you could even cut back on coupon supply if there was concerns about what was going on in the duration market and the long-term interest rate market. And still you wouldn't necessarily get to a mix, an overall debt composition mix that would be particularly concerning relative to history. And so what I'd emphasize is there is a ton of policy room that exists in the QRA by the Treasury over the next couple of quarters, and that given the range of policy flexibility that they have a significant ability to drive how long-term interest rates play out and what's likely to transpire in terms of interest rates coming in to the election period. And so I think in a lot of ways, rather than necessarily predict exactly what they're going to do, I think we saw in this most recent QRA, you could wait till the announcement and be responsive to it. But this is going to be the story, given the range of uncertainty and flexibility that they have over the course of the next couple of weeks. Again, thank you everyone for being here. I'm gonna go a little bit over the top of the hour, try and answer a few more questions. So if you have to drop off, I appreciate that you've come to join us, but might as well keep going here in terms of the questions. We've got another question here, actually a question about tips, which is great. Love talking about tips. Used to be totally uncool. No one had talked about tips until recently. The basic question of which is, what do you think, how do you think tips will trade during a period of inflation being elevated relative to expectations? And in particular, highlighting the fact that tips have not done well over the course of the last couple really the last 18 months or so as inflation pressures were elevated. And I think it's important to recognize what drives tips as an asset. Tips are a bit different than what people necessarily might think. Tips are really two things. They're a real interest rate bond and they're an inflation accumulation bond, right? Those two things are two different assets that have different properties. The inflation accumulation bond, right, basically is whatever inflation is, you get paid on your bond. And it gets paid out when inflation accumulates. And so that essentially is a very slow, in a high inflationary environments, that's a very slow moving instrument in terms of getting a positive return on your inflation. A real interest rate bond, which is the other side of a tip, right, basically can often change considerably when there is elevated inflation and central banks tighten meaningfully relative to expectations in order to create, in order to fight the inflation pressures that they see. And so what you see there is you basically see when inflation pressures rise, particularly during the acute early point of an inflation rise, what you see that those inflation pressures rise, real interest rates rise, and that causes a sell-off in those bonds. And so I think it's important to recognize that, in some ways, tips trade counterintuitively because of that real rate aspect and the central bank's responsiveness to it. But over time, tips pay you the inflation and the real yield that exists in the bond. And that's why when I look at the market and I see real yields as elevated as they are today, relative to the long-term secular dynamics in the US, I think they're quite an attractive asset to be holding. If you want more information about tips, I actually have a YouTube primer on tips. It's amazingly, actually, it's the #1 video that isn't one of these macro outlooks on the YouTube channel. So anyway, just definitely check that out if you're interested. Let's go to, I think we mostly have covered the rest of these preemptive ones. I think the only other question that I just wanted to quickly touch on. One of the questions, I think there's been really interesting in the course of the last 10 days, I guess, basically up until about 1 o'clock this afternoon, you had seen a meaningful rally in bonds. And one of the questions, or one of the discussions out there in the conversation is, are we seeing a set of, are those bonds rallying because there's weaker economic conditions? Or is there something else going on? Is it connected to the limiting of the duration supply? And I think that it's a very interesting question, an important question. And really, the way I would think about that question is stocks give you some insight into whether you're seeing an easing of monetary conditions or whether you're seeing an easing of growth conditions. And so what have we seen over that same time frame? Stocks have rallied a ton. Typically, if you saw a meaningful easing occur by the central bank, what you'd see is stocks and bonds both rally. In this case, it happened to be from the Treasury, not the central bank. And so what that tells us is that what's happening in the market is not a dynamic where it's weaker growth is causing bond yields to fall, right? Because typically what would happen in that circumstance is you'd see equities fall in addition to bond yields falling. It's not that dynamic at all. It's an easing dynamic. And that's really the point that I think is important to keep in mind, which is in order to continue to see the market action that we saw over the course of the last 10 days up until about 1 o'clock this afternoon, you have to see continued expectations of monetary easing, of real yield or long end easing in order to continue to get the equity strength that we were seeing. And I think today was a good example where just the inkling that the central bank would pull back created that shift in bond yields. And what happened almost directly is that decline in stocks that happened with it, right? Which is reflective of the fact that those policy implications are the primary drivers that we're seeing. All right, let's run through some quick other questions that are out there. I just touched on today's movement in the Treasury market. So thank you for that question. Let's just scan through here. We talked about the Howard Marks sea change memos and the pieces related to that. For those of you who didn't catch that, definitely go back. Is cash attractive in the short term relative to other assets? I think it's a good question. I think when we talk about what's going on in terms of all in, the asset markets are all in on the soft landing. I think when you look at that, that basically suggests that bond yields will have to be higher in order to accomplish the Fed's mandate, and that stocks will have to be lower. And so if you're holding a 60-40 portfolio, cash certainly looks attractive in that context. And I think, from a tactical perspective, that, that's basically what has to happen. And if you think about it more structurally, what does the Fed do? The Fed has the toolkit to change the value of cash relative to the value of assets in order to either increase or decrease the demand that exists, consumer demand and demand overall in the economy. And if you go back to what's going on with inflation in the economy and nominal growth in the economy being too strong relative to the Fed's mandate, basically their path to success to bring inflation down to the Fed's mandate is to slow demand. And the way that they need to do that is by lowering asset prices relative to cash in the economy. And so while in general, you want to be holding assets relative to cash because assets over time will outperform cash, tactically what we're seeing is an environment that continues to set up for more pain around assets relative to cash until the point that the Fed can clearly see that they're going to be able to durably meet their inflation mandate. That's really the dynamic that's going on right now. And so we're not there yet. And the set of conditions that are in the market are not there yet. And therefore continues to make sense, particularly for a 60-40 investor, to hold more cash relative to assets that are out there. We've got, let me see here. We talked a little bit about Japan already. Sorry, just going through the questions. I think this is a good question here from anonymous attendee, which is, what do you make of the argument that the Fed won't necessarily need to hike much more as real rates will increase with inflation moderating? I think when you think about what's going on, when you think about how do people absorb interest rates in an economy, I think a lot of sort of the disconnected academic view is they're thinking about real rates in this sort of precise way, but in terms of CPI relative to the short rate, in terms of how the everyday consumer feels about what's going on with the level of short rates, really, what are they looking at? They're looking at their wages, their wage growth relative to the interest rates that they're paying, and they're basically saying, is that a good deal for me or is it not, when I'm going out and thinking about buying a car or a house or something like that. And so when you think about that, and what I'd emphasize is when they're thinking about that, what they're also thinking about is they're not thinking about necessarily what's going on with the literal short rate, because most of the time, most of the borrowing in the economy is on the long end. And so if you think about what's happening there for the everyday investor, what they really need to have happen in order to slow their demand is they need to see a rise in those longer term borrowing rates in order to change their behavior, or a rise in those longer term rates in order to bring down asset prices, to kick off that cycle that we talked about at the opening. And so when I look at that dynamic compared to what's going on with the sort of classic idea of short rate versus CPI, the short rate versus CPI is a pretty irrelevant measure when it comes to what's going on with the overall tightening of dynamics in the economy. It's not really what people are looking at. And if anything, we might see counterintuitive dynamics there where you could have CPI fall, particularly in relation to income levels, which creates higher real income, which creates higher real demand, right? And so if anything, my thought would be moderating inflation could easily, without a coincident or commensurate rise in or decline in either asset prices or incomes, is actually marginally stimulative, not marginally contractionary. Views on, I think, that's pretty much, we've hit a lot of these different points. I think we've hit most of these points, and we're 12 minutes over the top of the hour. And I appreciate so many of you having stuck around for the totality of this conversation. It's been honestly one of the more probably the most fun macro webinar I've been able to do so far. Hopefully you all found it beneficial. Thank you so much for taking the time, and definitely come back and check out subsequent months